But now over the last two funds of ours, so call it the last 5 years or so, it's been about 15% of our dollars have gone into this space, kind of life science. And we started out talking about it as the intersection of innovation, where cloud and AI meets life science and biotech. And so those are the most exciting, most competitive deals. Both of those things, I think, drive the growth stage market, and I think we'll see more of that in 25.
Welcome to the Startup to Exit podcast, where we will bring you world-class entrepreneurs and VCs to share their hard-earned success stories and secrets. This podcast has been brought to you by TIE Seattle. TIE is a global nonprofit that focuses on fostering entrepreneurship. TIE Seattle offers a range of programs, including the Go Vertical Startup Creation Weekend, TIE Entrepreneur Institute, and the TIE Seattle Angel Network. We encourage you to become a TIE member so you can gain access to these great programs. To become a member, please visit www.seattle.tie.org.
Hello, everybody. Welcome to another episode of From Startup to Exit. My name is Gauri Shankar, here along with my co-host Shirish Natkarni. The podcast is produced by the TIE Seattle chapter, a nonprofit focused on fostering entrepreneurship. Shirish is an author and serial entrepreneur. His latest book, Winner Takes All, is available everywhere books are sold. We both would like to thank all of you for supporting us on this journey. For those here for the first time, please like and subscribe to our podcast, and both of us will be grateful. It is a brand new year, and at the beginning of each year, we talk to 4 leading venture capitalists to get their prediction and see how they did on their previous year predictions. As we enter 2025, we are talking to 4 of them again. Shirish, please introduce our guests.
Thank you, Gauri. I'm really excited about our podcast today. We have an exceptional panel of VCs from Seattle and the Bay Area. From Seattle, we have Tim Porter, Managing Director at Madrona Ventures, and Kellen Carter, Partner at Fuse Ventures. And from the Bay Area, we have Suman Natarajan, who's a Senior Principal at B Capital, and Sudip Chakrabarti, Partner at Decibel Ventures. Welcome, everyone. Now let's go on to our questions. So Tim, now that we're in 2025, would like to understand from you, what was 2024 like from an investment perspective compared to the previous year? And was AI the primary focus of the investments?
Yeah, AI certainly was. It is amazing. We're in 25. Thanks so much for having me. In reflecting back on Madrona's 2024 and mine personally, there was a lot of investment in AI, and it was a very active year. Our pace was really kind of consistent on early stage companies between 2023 and 24, and our new investments in some of the what we call acceleration stage actually ticked up a bit. And I think those two metrics are consistent with the overall VC market. So just to give you some specifics, so in 2024, Madrona invested in 16 new early stage companies. There were 5 pre-seed, 5 seed, and 6 Series A. In 23, we did 13 companies. So 13 companies to 16 companies. Both years, the split between, seed, Series A was about the same. We're kind of roughly, a third, a third, a third between pre-seed, seed, and Series A. In 2023, across those deals, we invested 56 million. Those were initial checks. And in 2024, it was 55 million. I was actually surprised when I went and looked at that it was that close. So a few more companies, generally pace was similar. We also invest in these kind of Series B and B plus companies. We call it acceleration stage because we're a click earlier than firms that consider themselves growth stage. And there in 23 deals, one of them was a new company and 2 of them were into existing companies, which is unusual. The fund exists to invest in new companies. So that sort of shows the overall market was still pretty slow for those later stage deals. And then in 2024, we invested in 5 companies, and they were all new investments, and mostly were AI related. In terms of kind of sectors. You asked about AI on the early stage companies, and I'll mostly talk about those. That's where I spend most of my time, and you could tell that's the bulk of our focus. Of those 16 deals, I'd say 6 of them were AI intelligent applications, so app level. 7 of them were sort of data and infrastructure, and all of those data and infrastructure companies had some AI platform, kind of flavor. One cybersecurity company, and then we call it AI bio or digital biotech. So we did 2 of those, and so those are kind of AI deals also, but in the biotech realm. So that gives you a bit of a flavor. I think that our biggest theme for the last couple of years has been applied AI, intelligent applications, and the software infrastructure that powers those intelligent applications. And we'll expect that to continue into 2025. And I know we'll pick that apart and talk about that more looking forward here as we get into the conversation. But hopefully that gives you a sense. So overall, it was a busy year, pretty consistent with where we've been the last couple of years.
Yeah, we definitely saw a pickup between 24 and 23, which was really exciting as an investor. I think the market started to ease up on valuations, and I think we also saw enterprise buyers also starting to ease their budgets as well. So that bode well for the broader market in general. I think we're hoping to see that continue to unfold in 25, which is really exciting. And absolutely, I mean, AI and just core enterprise software in general has become almost one with AI. You do have kind of the core AI platforms, but we're seeing AI getting sprinkled in or embedded into almost every existing solution, even if it isn't front and center. So like it or not, it is the focus, even if we're trying to have some kind of contrarian strategy there. So yeah, absolutely.
So 24 actually was busy, but in a good way. I think in 23 in particular, things were crazy, but also with crazy deals going down, like in terms of valuation, just kind of nature of some of the companies that were getting funded astronomical sums. In 24, I think the market normalized in a positive direction. I wouldn't call it fully normalized, particularly for any company that could spell AI, but still it was much better than 23. And I think for us in particular, we did multiple investments. I would say not every one of them was related to AI, but I would say many of them had AI component. And it was actually refreshing to see some of those companies actually showing real customers, showing real revenue. So I think some of those companies obviously were able to command premium valuations naturally, but both founders and investors were more clear-eyed in 24 for good reasons. Because last thing I would say is you guys know this, which is the valuation of the current round matters because you have to really hit it out of the park for the next round, right? So if you're raising at a crazy valuation this round, the next round becomes much harder to raise. So that's why I think the normalization was needed and actually appreciated.
I think 2024 was probably one of the most rapid changing environments that I've seen as being a VC in the last 12 years. Historically, when I started in this game in 2013, it was multiple years of SaaS. And you fast forward to 2023 and then into 2024, the rate of change and pivoting to AI or agent-based services happened so fast that the whiplash that we're all experiencing really feels like once in a lifetime. So it's almost like Moore's law and how fast things are changing, not necessarily accelerating like compute. And so it's one of the funnest environments that I've ever experienced, but it's not slowing down. It doesn't feel like it's slowing down at all right now.
Excellent. That's an amazing amount of data. That's great. Thank you so much. Curious to understand how valuations were impacted in 2024. And I understand it's a mix of, valuations have become normalized, but at the same time, the AI market has been frothy. So I'm just wondering what you have seen from a valuation perspective.
Yeah. The overall data, that you get from PitchBook on their Venture Monitor overall 2024 data is that valuations ticked up a bit in 2024, and the percent of all deals that were AI deals ticked up a lot. So in 2023, overall across all venture was like a third of the deals were AI, and in 2024, like half, said they were. And of course, how do you define, I was speaking at one of our company's sales kickoffs earlier today, and there was another board member on the panel with me, and he had a good, he's like, AI is like electricity, it's in all of our companies. They all, so it's almost everything is AI. To your point about valuations, though, I would say, my sense anecdotally is that overall, there's been a reversion to a little bit more historical ways of thinking about valuations, a kind of more rational, reasonable, not that it's founder unfriendly, but also that it's, not so high that it seems like irrational. And how's this company ever going to grow into these valuations? So I think overall, there was a continuing like rationalization on valuations. That being said, with some especially pure AI deals with really strong teams that just kind of go nonlinear and get super, super frothy. So it's sort of an interesting, market in that respect. But I felt overall that the valuation regime kind of stabilized, still kind of coming down in some ways from where it was in 21, 22, but there's certainly um, a lot of interest and competition, particularly around certain AI companies. And I think where that netted out for the industry as a whole across all deals is that valuations ticked up a little bit. Here in Seattle, I still feel like we were where most of our deals are, not all of our deals. We're up and down the West Coast now. We have a team in California, but still, 2/3 of our deals are kind of Pacific Northwest. And for myself personally, I've been super focused on Seattle market, which is a great market. Lots of talent, lots of companies getting for them.
Yeah, I mean, you still did see a much frothier environment for AI companies specifically. We also saw that, I think, for, cyber as well, which makes a lot of sense. I think the adversarial automated attacks and those environments are continuing to increase, and that space remains really relevant for enterprises. And then we saw, we saw kind of those companies that may have struggled a bit more in 23. One, either see some kind of soft landing or exit the market, or in their next rounds see, a little bit more kind of favorable pricing as well, which I think is good, because a number of these companies have already built a tremendous amount of customer love and growth, and it's good to see that they can continue along to hopefully find an exit themselves or find that second wind going forward.
I would say for the non-AI deals, it was obviously much more metrics driven. I mean, the market has cooled off since 22-ish, right? So people are funding companies based on, again, multiples, ARR multiples, forward looking ARR multiples, revenue multiples, those kind of things. I mean, there's a range always, because if it's a great team in a great space, even if it's a non-AI company, they still got premium multiples. But in general, I think enthusiasm was guided by multiples for companies that actually had real revenues and were not in the AI. I think in the AI space in particular, if it's a really good team, did not matter that you didn't have a single line of code. You still were able to raise. Like I said, the valuations came down for sure, but still, if it were not an AI company, those companies probably would not be able to fundraise. But if it were an AI company with a really good team, not a single line of code, still were able to raise. And raise from great firms, raised credible rounds and everything. For AI companies that were in revenue, I would say very frankly, most of the companies we saw that had some kind of traction were mostly like, I would call them POC traction, design partnership traction, some early paid traction for sure, but still very early. We did not look at any company that had astronomical revenue traction and would be called a pure AI company. At least that wasn't in our set for 24. I'm sure there are like a couple of them out there, but that wasn't us.
There's really a tale of two camps right now, Shirish. You really have things falling under the category of haves, people that have been there, done that, been, elite product leaders or business leaders at really important companies, or return founders that are raising $10 million without a single line of code, sometimes more. I mean, look at Elon on X.AI, although he has a huge advantage against Elon. And then you have the other type bucket of founders where it might be a little less experience, or the pitch deck isn't rock solid, and they might be doing the exact same thing, but are scraping by to get nickels. And so the camp of have and have nots, there's a huge bifurcation in the market. And I think that's a reflex of the rate of change that I just referred to, where things are happening so quickly. So if there is a movement happening, we are going to capitalize what we think is the winning team to go take advantage, because you now can move so quickly. You don't need to hire a giant sales team or onboarding team. This agent world that we're now living in, change and adoption can happen with way fewer people and happen way faster.
Right, great. So looking now into 2025, what's your expectation of how the economy is going to do and how that's going to impact investments? I mean, we now have a new regime, and it talks about tariffs and deportations, et cetera, which could significantly affect inflation and interest rates and so forth. So I'm curious to understand what your forecast is for the economy overall.
Yeah, it's a weird time. We in general are not trying to, prognosticate on macro, and kind of year in, year out basis. And that our fundamental strategy is invest early, plan on working with companies for 8-10 years, live beyond, up cycles and down cycles. And if you keep doing that, you don't have to be so sensitive to, that being said, of course, we're all wondering. I think that one thing that we'll see is that that M&A will open up some more. There was just a lot of restrictions in the previous administration, especially for the bigger companies. The number of companies that Microsoft, Amazon, Facebook, Google were buying just had plummeted. So I think broadly you'll see M&A pick up. It picked up a little bit last year. I think you'll see that pick up more. My sense is that sort of enterprise and consumer spending, especially let me talk about enterprise, has stabilized, and it's not, roaring, but it's, companies need to invest in AI. They need to invest in security. We've seen that pick up and stabilize. Companies have gotten through their multiple rounds of rifts. We talked about that last year, on this podcast. So I think those are all positive. Yes, there's, uncertainty around just geopolitical, inflation, et cetera. Hard to say. I'd say overall, we're kind of going into the year as business as usual from from how we're thinking about investing and how our companies are setting their operating plans for the year. It continues to be about efficient growth. How do we push growth as far as we can while staying efficient and low burn multiples, thinking about when we have to raise our next round, kind of all of those things around balancing efficiency and growth continues to be top of mind for companies doing their operating plans for 2025.
Yeah, just from a market perspective, I think the broader market in general, this is not me alone, is anticipating a improved environment for IPOs. And I do believe also it will also increase just because there is a considerable amount of cash on the balance sheet of some of these large tech platforms. And as their market values have continued to rise with the advent of AI, I think there's appetite to make those kind of cash acquisitions to accelerate their roadmap and continue that focus and priority. The broader macro, I think there remain a lot of questions and uncertainties, as I think we're expecting a number of different changes on that front. So I'll just say that from the market perspective. In terms of how it's impacting investments, look, I think the opportunity with a healthier market, even on the public market side, is that filters down to enterprises and how they spend. And that really is, I think, a leading indicator for some of the startups that are starting to see, post product development, starting to sell in the market, their ability to acquire customers and their ability to sell into customers who are willing to purchase best of breed solutions versus platforms becomes much easier. And so I'm hoping to see that acceleration really be a positive tailwind for a number of enterprise startups. And so from that standpoint, the challenge then becomes, how do we make sure that we're investing in those that are mission critical and will endure, given the number of innovations that are kind of behind them or that they're building upon. So that's kind of the opportunity.
So, I mean, I don't know if I'd be the right person to even answer that, but I'll tell you like a little bit of, I'll cheat there a little bit because I was recently on another panel where there were a lot of public investors in the audience, and they actually did a poll on like what they thought where the economy was going to go into 2025. I think the consensus was moderate growth, and when I say moderate growth, the range was 10 to 15% growth. And if you really look at last couple of years, I think the growth consensus was a little lower than last couple of years. It wasn't like super bearish, but it wasn't super bullish either. From my standpoint, because we at Pruven Capital, the way we work is we are an independent fund, but the value we bring to the table for founders is really helping them sell into large corporates. So as a result, we are constantly talking to the CIOs, CISOs, CTOs, CEOs of large Fortune 500 to 1,000 organizations. If I kind of summarize what we are hearing from them is, it's not like we are going to slash our IT budget, 20%. That's not what they're saying at all. But what they are talking about is efficiency. So for them, efficiency is a big part of 2025. So everyone that I can think of within our network, and we have hundreds of such corporates, everyone is investing in some kind of automation technology. Everyone is thinking that a lot of the processes they have that use humans could probably be partially automated or fully automated. But at the same time, they are not thinking of like cutting their human workforce either. They are thinking of finding other more valuable work for their humans. So I would say by and large, the corporates we work with, the message from them has been, we have cut deeply enough to get efficiency out of our human capital. Now is the time to get efficiency out of automation. So that's really the focus of 25 for, I would say, in general, from what we see.
I think the jury is still out because there's a lot of things happening on what the inflation print will be 12 months from now. Some argue that, hey, the tariffs are going to be highly inflationary. Others argue that it's just reciprocal for, other countries applying tariffs to us, et cetera. And so I think the jury's still out. I think there's a lot of enthusiasm from the business community that the deregulation is going to spur a lot of economic growth, that there's going to be easier to conduct transactions. You have companies that want to sell but don't want to sell right now because of the current administration and the current FTC. And so you saw 2024 as a waiting game to see what would happen with Lena Khan, with the existing administration. Well, now that we're entering 2025, there's a lot of enthusiasm that deal making will happen, that capital deployment will really happen, that the US, albeit with a very mismanaged budget deficit right now, is still the best house in a bad neighborhood in terms of the best place to invest in the world. So I think that will continue, but I think the deal making will really ramp up, particularly in M&A, where there's just a lot of companies that are on a clock that need to find outcomes, because every time we raise a fund, you're on a timeline. So a lot of these companies are now on a clock. You have a deregulatory environment, and I think hopefully rates will go down, hopefully. The confluence of all those things should make for a pretty exciting 2025.
So again, looking into 2025, what are going to be the focus areas for your investments? Is it going to be primarily AI again, AI data infrastructure?
Yeah. As we touched on earlier, from a macro themes or a mega trend standpoint, applied AI and intelligent applications, there's been a lot of discussion around AI agents and agentic applications. Nobody even sort of knew that agentic was a word 2 years ago. And I think that's real. Of course, the big Salesforce and others are really banging the drum and turning it into kind of a marketing, food fight around agents. But we think that's very real. We are seeing using agent-based architectures to rewrite applications and envision new ones. I think this won't play out fully in 2025, but over the next, 2 to 3 years, agent-based interfaces, really, I think, reimagining a lot of the way we interact with software. You're hearing, and we wrote a post recently, my colleagues Soma and Sabrina wrote a post about SaaS is dead. And that's provocative, and people, what do you mean? I think embedded in that, there's a couple of concepts that you'll see play out further this year is that the user experience, the way you interact with software, you go to a web page, you go to a forum, you type in a bunch of things, you navigate screens. I think that will more and more be, instruct your agent through some sort of natural language to accomplish A, B, and C. And I think the way you pay for software is going to evolve. This won't change overnight, but instead of, based on seats and things like that, you'll see more, how can companies based on outcomes, based on some version of ROI. So we're going to invest heavily around these agent-based applications, as well as we've really thought through, what what does it mean for an agent-based architecture? Where in that stack do you need new companies and new tools? Where will you use existing companies and tools? Where will those tools come from existing providers? Where will the new companies need to be created? So I think that will be a big theme going forward. Last thing, I'm sorry, I do think there will be more. We talked about this last year, and we saw it in 2024. The fragmentation at the model layer. It's not just OpenAI. OpenAI is amazing, but you see a set of other, mega model providers from Anthropic to Llama to Mistral, etc. And I think we will see more and more open source, more and more domain specific models where companies or organizations, they have their own data set. They can start with something in open source. They can build and train or fine tune a model to fit their specific need with their specific data. And then insert that into whatever their business process or insight is. I think that will continue to become more and more prevalent, and allows you to make investments in, let's say vertical markets, where here's a new application, new model, it's allowing a new set of insights or workflows around a vertical market.
Yes, in the short answer, yes. But more specifically, the things that I'm personally really excited about, one is really as AI is getting adopted, I think there were a number of day two solutions that were emerging in the past couple of years that were anticipating a certain level of enterprise adoption. I think those are going to start to mature, and I think it's really exciting to see the companies that are able to go after, the monitoring space, the security space, and so forth. I think there's going to be an evolution of a lot of those companies that emerged initially to tackle those problems, and then now new companies that are going to take some of the existing assumptions and build upon that. Next, I think there are some spaces that are super ripe for disruption within the cyber and DevOps spaces as well, and that's really with the opportunity to combine LLMs, use some kind of deterministic modeling to ensure that they are going to be viable in critical workflows, as well as leveraging agentic capabilities to actually complete tasks versus only assisting. So I think that's the opportunity, and I'm excited to see that be really disruptive in the infrastructure layer. And then lastly, an area that I'm super excited about is just how AI can be used, again, leveraging some of those similar capabilities to be disruptive with some of the system integrator platforms as well. I think the services market generally has been a core focus area for AI investors because we see the opportunity for LLMs to be highly disruptive in that regard. But specifically in thinking about the kind of core technology tools of Oracle, SAP, a lot of these that are embedded within traditional enterprises, the services ecosystem that surrounds those types of tools is massive. And I think we hopefully can start to see some of those spaces start to get disrupted as well. And I think that's incredibly exciting to see that change unfold.
If I didn't say agents, you guys will throw me out of this podcast. But I'll start with something that is a little out there because it is actually something we are pretty excited about. And I'll say in many ways, it's actually beyond agents. And what I'm really referring to is more like service as software. And we have a very strong thesis, and we have been working on this as a firm for the last year plus and made some investments in the last few months as well. But we kind of look at every corporate partner that we work with. We look at their budgets, IT spends. And typically, every company is spending more than $500 million every year on Cognizant, TCS, Deloitte, Infosys, you name it. And it feels like that business model is stuck at a very different era, which is like very people driven. The efficiencies are obviously annoying, but I think much more annoying to many of these corporates is the time it takes to turn around a project. If you're building an integration between system A and system B, it takes like 2-3 months just to get it back through these SIs. Take all the design, building, testing, all of that. And then maintaining that is also a pain. So long story short, I think there is a fair amount of opportunity to disrupt some of their businesses. Not all of it. I wouldn't say that. I mean, they have very deep relationships with all of these corporates. So it's a multi-decade journey, but I think technology has gotten to a point where it's actually not unreasonable to think that a new services firm can be built that will still look like a services firm to the outside world. They will still have people, delivering the service, but under the hood, it will be powered probably 80-90% by software. And we are seeing that trend coming up in different areas that traditionally has been served by these SIs. So we call it service as software. We have an inside joke saying we are going from the SaaS world to another SaaS world. But I think that's actually something is a pretty strong focus for us as a firm. And then, of course, everything else that is going on with, will SaaS be dead? Will agents take over the world? And there's definitely time we are spending there. But I'll pause there for any further question. But again, like I said, I wanted to throw out something I haven't heard as many investors talk about or being focused on, which is like, okay, instead of thinking about agentic stuff or Copilot, which is even the previous generation, can you deliver the whole thing as a service?
The pace of investment, so the focus, I'll address the first question. We're playing the game on the field. Traditionally, we are software investors through and through. Historically, like I mentioned, that was SaaS and seat-based pricing. Now there's just a different way of pricing and delivery to some extent. And we're really enthused about the vertical applications of AI. You're seeing scenarios that could never have been solved with software now being completely unlocked. Things like claims management. You used to have claims agents and insurance companies have to review all these documents, hundreds and hundreds of pages. Now AI can enable you to review the claim and all the appropriate data and important data in minutes. Things like freight forwarding, where a freight forwarder has to deal with shipment documents from 15 different counterparties. AI can now tell you where there's errors in your shipment documents and where you might have an issue with customs. So things where there's a ton of paper and a lot of, I would say, cost center people are now seeing huge unlocks with AI doing better, faster, and cheaper work than an actual human can do. So very vertical domain-specific solutions. Where we're also seeing a lot of really interesting opportunities is actually in space. And this is a new Fuse development really over the last year. And a huge shout out to my partners, Brendan and then Nolan Van Nortwick, who have really dedicated a ton of energy and output into finding really interesting space companies. And we're really excited about the next generation of applications that space will bring beyond connectivity and more around compute, like data centers in space with Lumen Orbit, and then around management of satellites to provide services to the terrestrial world.
Got it. Thank you. Over to you, Gauri.
Okay, great. Tim, so you talked about quite eloquently about agentic applications, right? Let's just kind of pick on that theme because that's going to be a key focus of your 2025 investment. So you talked about architecture, interfaces, how we interact with them, and then business model. SaaS is dead, right? So in the previous versions of those software, either the business model drove the architecture drove the business model. Now you have the business model dependency on bigger model providers, right? There's an underlying. You have agents with the architecture on top, then you have the interfaces that you're making it easy. So your investment thesis, getting back to that, right? Are you focused on an agent application, which is here now in 2025, that you see will take advantage of one or the other? That is, either the business model is somehow clearly measurable, so you can extract the value out of it, or the architecture is so flexible that you can build a business out of it. Where in the Madrona, Tim Porter mindset is this sitting?
Thanks, Gary. It's interesting, really interesting question. Our mindset is always to try to work back from the customer. And our partner Matt did a post last year called, something like the most important model is the business model. And I do think sort of working backwards from the customer need, which may mean business model innovation, is the way we're going to evaluate new opportunities, not working forward from like, hey, this is a super flexible architecture. I think you get into a risk around being too, tech driven, that you've got to be customer needs driven. But that being said, I don't think in all cases it will be, hey, this is some radical new business model, or that everything is going to flip to pay for performance. I think in certain areas you'll see that, or in certain cases. So I don't mean to make that a little bit of a non-answer. We're always trying to look for the intersection of technology enabling some new customer problem, and the business model is usually more important than the technology architecture there. So that's where our thinking starts. Sometimes the way you go find those opportunities, though, is to try to follow the technology innovation, right? And then think about like, okay, what's the business model implication? What's the customer implication for this? Whether that means, going to conferences like NeurIPS and reading the papers and hearing what the new things that are coming out. And that's part of the role of what investors are supposed to be trying to help with, right? Is help, founders think about like, okay, how do I apply this, this new breakthrough that I'm working on? But if we had to pick the answer to your question, we would work from the business model and the customer, not from the technology first.
Yeah, I think what we saw in 24 was a number of different modalities come out. We have like pure play, agentic development platforms that have been, starting to penetrate the enterprises. But we also have seen like large SaaS companies and other more vertical or end user facing applications leverage agentic capabilities as well, which I think now is going to be an interesting moment to really see which of these types of forms of kind of that agentic capability is going to win in market. My early hypothesis there is that having those frameworks embedded into existing tools that provide a system of record are going to have an advantage over those pure play, just because they're providing their time to value is going to be more immediate. But in the long term, the pure play agentic platforms should have an advantage because they should be very sticky, because they can be customized for exactly the enterprise need. But we'll see. I think this is going to be an interesting year where we should hopefully see some of that battle play out. I also think that the creator economy and the developer ecosystem is starting to come back in full force. I think we saw, as the market kind of was more quiet, a lot of the developer swipes of credit cards had been closed off. And I think that's going to start to emerge because experimentation is not just top down, it's also bottom up. And I think enterprises are trying to figure out what those kinds of opportunities are as well. So excited on all those fronts.
Yes, it's a really good question. It is, I would say, service as software is the next evolution after agents. If you really, I actually saw this presented by some company, which I thought was really good. I think if you really think about evolution, we started with more like data retrieval, search kind of capabilities when it comes to AI. Then came the copilots. Okay, so it's basically a tool that works. Basically, you can do work with, right? Then came the agents, which is AI that actually works for you. Basically, you tell it to do some task and it goes and does it for you. And then the service as software pieces like that AI that completely gets the end-to-end work done for you, right? So that's kind of the ultimate evolution. Now, agentic solutions are very much core of any service as software offering. So, like I said, it's a very much an evolution. Our thesis is there have been a ton of use cases where agentic solutions will disrupt whatever SaaS or multitude of SaaS tools you're using, right? But then if you take it to the extreme, you could say, well, those agentic solutions could be part of the entire service offering that can be delivered to you as a work product. So to answer your question, it's really an evolution. And then we are barely getting started with agentic solutions, frankly. It will be, again, if agents work out. I think there is an if, by the way. I mean, I don't think it's a given that, okay, all of this will work out seamlessly and it will be so easy to displace, a decades-old habit of using SaaS and so on. And also you need to figure out the UI for agentic solutions. Big, part of it, right? But if they work out, I think enterprises will be locked into agentic solutions for the next 3 to 5 years.
So you do feel they will make an appearance in 2025 in reality, right?
In reality, yes.
Okay.
Again, I would say we are already seeing some of that, actually. It's limited in terms of actual production use cases. I think the hype always precedes, right, with all of these things, right? So every corporate we interact with has some kind of effort going on around agentic AI, all the way from the CEO, CTO level. So we ourselves have spoken to multiple such, what I would call corporate-wide, like innovate events or brainstorming think tanks, you name it, right? Small, large, all kinds of efforts. But agentic AI, everybody is sitting up and thinking about, okay, could I get a lot more efficiency out of like spending, on 500 different SaaS tools, which I may not be utilizing as much as I think, or as much as I'm paying for. So that's what I think out of the agentic AI interest is coming in, which is like efficiency and speed and cost, of course.
I think a lot of them are already here, to be honest,
Yeah.
Gary. And I think what you've seen in some of the early portfolio companies from Fund One have already moved towards agentic workflows and applications, like I mentioned with the example with claims management or fraud detection with Owl. And so a lot of these companies are really refactoring their software and their pricing with more AI for very vertical specific scenarios. Where you're not seeing us spend a ton of time is in the foundational model game. It requires so much capital, so much compute, so much money to train these models, and they're very, very necessary to unlock these applications. But with a smaller fund like Fuse, it's really hard to play that game where you see, I don't know, Anthropic's going to raise another $2 billion. That's next the size of our fund just in that round alone right now. And so we've stayed a little bit away from the foundational model game, but we see them similar to that of the web browser to enable these new apps. The web browser enables SaaS, agentic applications, or the foundational models are really the web browser to enable these vertical agentic applications. So I always like doing analogies or comparing the new generation versus the generation of the 2010s. And that's how we're really thinking through some of the investments that we're making.
That's a great analogy of web browsers, because all the applications that were built based on the browser being stable and available, right? I mean, it's just everybody said, "Oh, go to your browser and do it." It took a while to train people what that was, but once they got it, it got there. That's actually an excellent analogy.
Yeah, look at our video conference right now. It's enabled by the browser.
Exactly. Got it. So one follow-up, which is you mentioned you have opened up AI bio, right? As a biotech sector with an AI overlay. Historically, Madrona has not necessarily wavered from its technology focus. This also is technology, but it has a very different, underlying science to it, so to speak, right? What's the history a little bit, and as to why you guys chose it? Second is, how do you apply the 30-year learning to a completely new sector, which 8 years seems like tomorrow in a drug discovery game, right? It's like a 10-year, 12 years. Like, these are long cycles with a complete 1-0 failure at the end of 10 years. So if you could just elaborate on that, because that's so unique at this juncture in your history.
Yeah, thanks. We have the benefit of being friends for a long time, don't we, Gary? We were so you know the history and kind of where we started and where Madrona started. This is a great topic, and in fact, if you and your audience are interested in biotech and AI bio, you should have on one of my colleagues, Chris Picardo or Joe Horseman, who can go really deep in this area. So I don't spend as much time here. On the other hand, we're all one team. We have one investment committee, and so I'll tell you our thoughts and our strategy on this. So our first investment in the AI bio space or the applied biotech space was actually a number of years ago. It was Nautilus Biosciences, which the co-founder and CEO is Sujal Patel, who was the founder and CEO of Isilon, who was one of our big early winners in the storage space. You probably know that company well. And that was all the way back in 2018 when we made that investment. So this isn't like a brand new strategy, but now over the last two funds of ours, so call it the last 5 years or so, it's been about 15% of our dollars have gone into this space, kind of life science. And we started out talking about it as the intersection of innovation, where cloud and AI meets life science and biotech. So how do we learn our way into the space? First, is trying to pick opportunities that were really IT breakthroughs, ML breakthroughs, using cloud, using data, etc., as opposed to laboratory science breakthroughs. We have partnered closely with institutions here especially in Seattle, that we had long-standing relationships with and had a real trust-built relationship. So, Matt was the chair of Fred Hutch, and we've done some spin-outs out of Fred Hutch. We've done a number of spin-outs out of Institute of Protein Design at UW. We've done other things with UW. We've done other things with the two Allen Institutes, who've done some things in biotech and brain science, et cetera. And then we've worked with co-investors who are, live, breathe, and are wholly focused in the biotech area. And we've worked with founders who we came to know and trust. And so we didn't just start sort of plying the globe, and trying to go bid on, other technologies and companies that we knew cold. We wanted to get an early, partner closely, and stick to areas that we felt like we understood some of the key success factors around. And we've really liked that strategy so far. So we have a number of companies. A company like Teray just raised a big new round from a growth investor, and NVIDIA. They're using AI to do, new types of drug discovery. We've done, as I mentioned, a number of things out of IPD. We had David Baker, who won the Nobel Prize this last year. He spoke at our annual meeting a few years ago. So that's been the way we've got into it. And then last, when I mentioned have Joe come on, I mean, we have people on our team now that this is all they do, and Joe has a PhD, in this area, and worked in biotech. And then there's some others of us on the team who had worked in this area, but also worked in other areas of investing. So we try to bring the right, team members to bear to make good decisions in this area.
Right. Looks like the fundamentals haven't changed. Work with the founder, know about the founder, and grow with the founder. That's same whether it's bio or technology.
Absolutely right. But to your original point, though, the milestones and the timing is different for these biotech companies, right? And sort of we've tried to be, milestone based around, and I don't mean specifically like structuring and tranching investments, but just thinking like, all right, we're the pre-seed investor. What can this company actually solve to raise the next round? What do you have to solve to raise the next round? Being cognizant of, at some point, the exits for these companies are licensing or selling to larger pharma companies who then actually take it all the way to market. So there is a different set of factors in thinking about the company life cycle, but the fundamentals around differentiated technology, founders that you trust with high integrity, attacking big markets, important problems, those are all exactly analogous to what we've always been doing.
Got it. Switching topics to another sort of a bigger trend, the IPO market. There was some, openings in 2024, but there wasn't a gush, right? There's some trickle. Did you guys, did any of yours go public from your portfolio last year?
No, we didn't have any IPOs. We had a few very nice M&A exits. The biggest ones for us were Rover, which had been a public company and then was taken private by Blackstone. That was well over $2 billion. There was a company called Jama Software that was bought by Francisco Partners for $1.2 billion. Lexion was an AI deal that was bought by DocuSign. So we had some good liquidity and good M&A, but we didn't have any IPOs. And you're spot on. The IPO market opened a little bit in terms of the number of new issuances. There was some good IPOs that happened, but there wasn't a high volume of them. Service Titan here right at the end of the year was a good one. There was a chip company, a semiconductor company a little bit earlier in the year called Astera Labs, but there weren't a ton.
So just to follow up on that, are these private equity deals the modern IPO? Do you see more of that in 20? I mean, the exits are enormous. I mean, they're not. I mean, 2, 3, 4 billion too, right? They're capable of assembling any amount of capital. So without the regulatory hurdles, you get to enjoy the exits, so to speak, right? Not commenting on whether regulatory is bad or good, just the truth of what it is.
Yeah, I'd say yes and no. There's certainly more of them, and the scale has gotten bigger. And I think you're going to see more of that activity in 2024 and going forward. A different related dynamic is private to private mergers, which I think you're going to continue to see more of for a few reasons. One is that you have a bunch of companies that are at sort of medium scale that raised a bunch of money and now are trying to figure out, what to do. And back to the IPO market, it's not that the IPO market is closed. It's just that the scale you have to get to have an IPO has gone up so much. Back, 10 years ago, it could be you're at 100 million, 150 million, you can go. Now it's 300, 400 million. It's just, big scale. And then, the companies don't like the valuations, the multiple. So, you could go public. You just, if you're Databricks, you could go public, but you like the valuation. You just got in the private market and you can, raise, an enormous amount of capital in the private markets at better prices and then not have to report every quarter. So, when you have companies like Stripe and Databricks, they could certainly be public companies. They just choose not to be. So I think in this year, I think you will see some more IPOs. I'm not sure that you're going to see a gusher, of IPOs coming back, but there are definitely a bunch of interesting companies that are, in some degree of filing, and you'll see some of those come public in 2025, whether it's more people trying to cash in on the NVIDIA semiconductor, all of things happening around AI chips and semiconductors like a CoreWeave or a Cerebras. There's companies and categories like cybersecurity, like Sneak, who's I think they're at the right scale and profile to be an interesting public company. You really want the Databricks, Canva, Discords. I don't know. I think you'll not see, maybe you'll see one, out of that type of group come public this year. Stripes, Klarnas, et cetera. So I think there's a great backlog and we'll see incrementally more, but I don't think it's going to be like a run on the IPO market.
Yeah, I think there is a broader market sentiment that it is a more favorable environment for exits and IPOs. So at this moment in time on January 9th, hoping that, that remains true, but we'll see.
I'd like to think so, yes, especially the second half of 25. Yes, short answer. I was really expecting, we know all the usual suspects that should go IPO, could go IPO, like the Stripes and the Databricks of the world. I was expecting actually Databricks to go IPO probably. I have no insider knowledge, but I was expecting them to go IPO in the first half of 25. Could still happen, but then of course, they just raised a giant funding round, 10 billion, all said and done. So I don't know anything better, but it feels like a lot of these companies that have been very successful, they might go IPO for a different reason, which is to give liquidity to their employees. And of course, if I'm in the right time in terms of interest in AI, interest in like really next generation companies from an public investor standpoint, I might actually take that opportunity when the volume is light, as opposed to having to compete with 5 other similar companies. So my sense is companies that are really ready probably will target second half of this year. Will it be a frenzy? Absolutely not. I don't think so.
Mm-hmm. Okay, that's so about the same you're saying as last.
Some of these iconic companies, I can see them go public late this year. I think that's my like very foggy crystal ball prediction.
Yeah, my opinion is that the IPO was viewed as a liquidity event, but the market's sentiments are lost in value creation, right? I mean, look, there's a whole lot of movement in the top, 5 or 6 companies that garnered all the value because the money going to public markets is still available. I mean, I understand PEs are giving the valuation, but there's something said to be gaining it from other investors too. But it'd be good to watch, I think.
Correct. And some of these companies that have the luxury of going to the private market to raise enormous amounts of capital. If I were running one of those companies, it's probably slightly more comforting from a strategic standpoint, right? I can make much longer term bets without having the scrutiny of quarter by quarter earnings calls, right?
I made the mistake of telling my wife that Icertis was going to go public in 2021, and so I've lost all credibility. It's like where are the dollars at? Like, well, hopefully one day.
Okay.
But I do think that there's a lot of, again, it kind of goes back to the clock that VCs are on, right? Where and companies are on, or what's the maturity? What's the profile of these companies? What do they need to look like to be IPO ready? Where they get tier 1 investment bank coverage, to where they're going to rise in the markets, and the markets are stable enough to buy and hold. And I think, and I'm hopeful that we're entering a year where there's a lot of stuff gunked up that's going to get ungunked up in the second half of the year. Now, the thing that concerns me a little bit is there's too much supply relative to the demand of the public market investors, and that's all got to get sorted out.
Is that the reason why you see private capital buying up companies at a fairly large valuation? And it seems like they're going public, right? You get a $2 billion buyout from a PE firm of, or Databricks not wanting to go public because their valuation is better than the IPO market might have given them.
Yeah, and there's a lot more comfort from Thrive, which you recently did that with both Databricks, I think, and OpenAI. And I think there's a lot more comfort in these transactions that are not necessarily on balance sheet, but they're to relieve stock options or provide liquidity for employees. And, I think the public markets make companies operate better. That's obviously a very debatable point of view where, some founders say, well, it's harder to innovate if you're a public company because people are short-term focused versus the ability to invest in the long term. You can see both sides of the coin and debate it 6 ways till Sunday. But I think public markets make companies operate better. Maybe a little harder to innovate, but certainly operate better. And so I think there's a natural, if you're a founder and you're in the public market fishbowl where you got 6 billion eyes on you every single day, yeah, that's a little daunting versus here's my board of directors and my inside investors and employees are the ones I need to appease. And so it's really getting over the psychology of getting there and going public versus taking these later stage rounds. Historically, and I think in 2020 and 2021, of course, with the crossover funds, there was just way too many late stage deals that got done, and it just kicks the can down the road before you go public. Well, then when the water went out or the tide went out, you got to grow into that valuation that's anchored in your mind. So a lot of founders won't want to go public until they hit their last private valuation high watermark. And I think 3 years later, 4 years later now, going into this year, 3 to 4 years later, a lot of these companies are finally probably getting there. So I think the psychology is now more acceptable for founders and boards as you're getting close to the most recent high watermark.
It could also help that at least at the moment, seems like the tech community may have a seat at the table of the new administration. So it could help in the regulation of how tech advances its exit. So hopefully. Okay, in your true fashion, in 2024, prediction was VC investment dollars, number of deals, M&A dollars will increase in 2024. How do you feel about that prediction now that you're in January 2025?
I was sort of right, but not like wildly right. I think you'd have to look at the numbers and say it was mostly consistent. They were up slightly. I think technically I was right, but I wouldn't claim victory on my prediction. Yeah, right. I think the overall, capital raised was up by about 20%. The M&A dollars were up by about 20%. The deal counts were pretty consistent between years. And so the thing that increased a lot was the percent of deals that were AI driven. And you started to see some of these Series B, C kind of later in growth stages start to come back, and that's why the overall dollars went up and the deal count stayed about the same. That kind of growth market, the Series B, C, D market from, middle of 22 through the middle of last year, there's basically almost nothing happening. And, even in our portfolio, we saw more interesting companies in that range, in the second half of last year than we had seen before. And I think there are a few different dynamics around that, which are going to continue next year. One is that you've got companies that were like born in this AI generation, born kind of in the chat GPT that are like getting to scale, like they're growing super fast and now they're rising Series Bs and things. And so those are the most exciting, most competitive deals. And then you've got a set of other companies who maybe they lived through, the downturn in 22 and they got efficient. They got efficient, they got their business. And so those companies are raising, and it's also far enough away from probably silly valuations and multiples that they either grew into those valuations or they're willing to take some sort of reset valuation. So you're seeing both of those things, I think, drive the growth stage market. And I think we'll see more of that in 25. I don't know that the early stage is going to get like even more busy. It's been busy. It's going to stay busy. I think it's kind of more of the same in the early stage side. And I think you'll see an increase in activity in the growth and early growth stage.
So in 2024, just to remind our audience, you said there'll be a couple of enterprise IPOs by the end of the year. That was your 2024 production. So was there?
Yeah, we saw Rubrik and Service Titan go out to market. I think and I anticipated Databricks would go out, but maybe in 25. That's now what is expecting. They're one of the many in the backlog, so we'll see. But yes, I'm glad to see that we actually started to see some enterprise companies come to market.
Okay, there's the moment of truth. Okay, this was your prediction in 2024.
I did.
There will be. I told you we'll bring it back. There will be an open source model that'll give OpenAI a run for the money. Has this come true? And what do you think the status of open source models are today?
I think I did pretty well. I'll say that.
You did. I would agree with you.
So I think back in 23, I was actually looking at some data on this, but back in 23, I don't think there was any model that was in the GPT-4 class.
Right.
If you take the leaderboard data that publishes or ranks all the models, I think end of 24 we have 18 other models that can give OpenAI a really good run, and some of them actually have exceeded. So take whatever the Llama's latest iteration is, and then the model that really shocked a lot of people was DeepSeek's model that they dropped, I think the day after Christmas, actually.
Mm-hmm.
And that one was as good. And I think in a couple of benchmarks, it was slightly better than GPT-4. I think the most shocking piece was it was trained using less than $6 million. So yes, I was very correct. Like that's the world we are headed in, right? It's like proprietary closed source model advantages, basically. I wouldn't say going away, but it's leveling up.
Yeah. Totally true. Because nobody wants to continue to give all the money to NVIDIA. So the moment of truth. You made the following prediction for 2024.
Oh no! What did I say?
I said, beware of the incumbents. Now, what did you mean by it? And do you think it has come true?
I think yes, and probably more so than I probably would have anticipated with Microsoft, with Amazon's Nova announcement recently. If I was Anthropic, I'd be like, excuse me, now we're competing with an internally built tool that everyone is probably mandated to try both. The whole purpose of that is to improve the Nova model to outperform the Anthropic model. I'm sure of it. No one's told me that. Those are Kellen's words, but I'm sure that's the point of view: is choose both, but make sure you try both so we can improve Nova. And so I think you look at where Microsoft's positioning, where Amazon's positioning with their data centers, with their compute power, with their big advantage. I think their market position is excellent and improving fast.
Yeah, that's an excellent way to look at it. Is how are they tackling as incumbents? How are they tackling it? So
when even look at Salesforce with it's no longer Dreamforce, it's Agentforce.
I know that,
and
they have a TV commercial.
You think about the huge advantage that they have, with CRM software and all the amount of text and semi-structured data in a CRM. And it's a really interesting, I was having a drink with a really close friend a couple months ago, and I won't say the name, but, I asked him, I said, what's been the biggest surprise? Your firm got acquired. What's been the biggest surprise to the buyer in a positive way? And he says, the quality of our CRM in today's AI world. And what he meant by that is when they moved completely remote in 2020 when COVID hit, then they came back to the office. If a meeting was not entered in the CRM, it did not exist and you were not comped on it. No one was comped on things that were not included in the CRM. So the discipline of the CRM hygiene ended up helping them build one of the most important data assets of what the strategic buyers and the private equity buyers are most interested in terms of assets. And now that they have that huge database of meetings logged, that's really, really important that they can now query and surface up insights for an M&A deal. So it's just, it was a really interesting insight in a non-tech company.
So the reason we are here to hear from Tim Porter, the prediction of 2025. What's your prediction, Tim, for 2025?
we've touched on, a few things. So I'll summarize a few things. I think you're going to continue to see uh, heavy pace of AI investing, especially around AI agent-based applications, domain-specific models. I think those will be dominant trends. I think you'll see a pickup in the Series B, C, D, investments. I think, one thing that I'll maybe go out on a limb here a little bit, and I think you'll see a billion-dollar plus exit in Seattle. I'm not saying that because I have any inside information on some company that's in a process. I swear on that. I just think that, maybe that's part of, more M&A happening. We'll see, but I think there'll be another big exit in the Seattle area this year, which would be great to continue to see.
You guys are pretty. I don't know. I don't know. I don't know if the word publicly I was going to use, but anyway. See, here's the thing. I do think, and I'm copping out a little bit. There's a little bit of a cop-out answer, but I'll say this. I do think that you wouldn't see any new model that has like huge number of like, let me put it this way. If there was a model out there today with 750 billion parameter, you wouldn't see one with, 3 times that this year. And the reason I'm saying that is I feel like, and again, obviously it's coming from a lot of the AI experts. I think that the advantage and also the data that you need to train another gigantic model that is 2-3 times the size of what you have, that slope is plateauing. So you wouldn't see a gigantically bigger model in 25. What you will see is a lot of this AI compute and use cases moving to the inference side of the house. And the reason I'm saying that is within our portfolio companies, when we ask around like, hey, what LLMs you're using for your application, more and more the answers are coming back as O1, O3 inference reasoning kind of models, because they are basically solving enterprise use cases. And for them, the bigger is not always the best answer. It is much more about accuracy and of course cost and all of that. So inference, the way it delivers accuracy or delivers much better accuracy than one big model delivering a one-shot answer. For them, that is important. And I think you will see more and more compute moving to inference. It's already happening, by the way. But you'll see the plateauing of training large models, building large models, and you will see a lot more AI compute moving to inference by the end of this year.
Okay, a couple. How about 2? And they're going to be way more specific than beware of the incumbents, because that's vague. That you can spin that to be right no matter what.
Yeah.
Amazon buys Instacart. DoorDash is too expensive. Amazon needs to have a better captive network. Flexi's worked out okay, but I just don't know anyone. I just don't know much about it. It doesn't have a ton of market awareness. Instacart does. It's trading at $11 billion. It's not $75 billion like DoorDash. So it fits in kind of that strike zone like Whole Foods, where it's going to get them further extended into their delivery network. That's one.
Wow. Bold. I like it.
There's bold. It's binary. It's either it happens or it doesn't. So you could say you were wrong. Here's one that's slightly less binary. Microsoft begins its detachment from OpenAI because they don't need OpenAI near as much as OpenAI needs them anymore. I think Microsoft is going to advance their models. I think with their VAR reseller SI network, and I think with where they're positioned in this AI world, I think beware Microsoft. And hey, OpenAI, they need Microsoft more than Microsoft needs OpenAI.
Fantastic. Thank you, Tim. With that note, we will record it and come back to you in 2026.
All right. Thank you so much, Tim.
Thanks.
Thank you so much.
Appreciate it.
Thank you so much.
Sudip, thanks a lot. Your insights are always great. Appreciate you taking the time.
Always a fun.
Thank you, Sudip.
So much.
Thank you.
Callan, true to your incumbent strategy from last year, you built on the incumbent. 2 predictions, both are bold. I love it. Both are local companies that could make a big change. Thank you for those, and we'll come back to you in 2026 to see which of those happen more. Both are going to happen. It's a question of which one's going to happen.
Yeah. The startup stuff, we spend all day working with startups. That stuff's a little bit easier, but I like to say, okay, let's put yourself out there and be okay being wrong.
Thank you very much for that.
Thank
Kevin.
you very much.
Appreciate it. Thank you for listening to our podcast From Startup to Exit, brought to you by TI Seattle. Assisting in production today are Isha Jain and Mini Verma. Please subscribe to our podcast and rate our podcast wherever you listen to them. Hope you enjoyed it.